Are you a new investor or an existing investor and want to know the difference between a cash out refinance and a HELOC? Well, guess what? Don't go any further because this is the perfect video for you. After watching this video, you're going to learn the key differences between both of them and why they're both important to your real estate portfolio. And it's all going to begin right after this. Hi everyone, Josh Tavares, investor and realtor with eXp Realty Brokerage. So amazing if you can help out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you're looking for great real estate investing with great appreciation, cash flow, low price point, click the link below, let's book an appointment and get you on your way. And without further ado, let's get started. Now let's start off with a cash out refinance. A cash out refinance is essentially very similar to a HELOC, however you're taking out equity in your home in which you're using and you're receiving a check of a certain amount. So let's just say your home was worth $100,000 for easy math, and let's say the loan to value is 80-20. You'll be given a check of $80,000 from your bank. Once you receive the funds, essentially it's cash into your bank account that you can spend however you like. However, that's when you begin paying the monthly mortgage payments or whatever the payments is you have alongside with your mortgage institution, in which you want to be strategic, of course, as real estate investors and use this to purchase cash flowing real estate investment properties. And with the cash out refinance, it's typically going to have a higher interest rate than your typical mortgage that you're going to have. So essentially, you're not having a secondary mortgage, you're refinancing your existing mortgage, and what you're doing is you're receiving the equity in cash and you're getting a whole new mortgage, whole new terms and everything as such. Now, before doing this, I highly recommend that you speak with a mortgage specialist who, like we've said in all our videos, specialize into real estate investments and has access to their own properties so they can give you the best lending products based on what you're looking to get into. It's really important to know that when you're going about getting a cash out refinance, know exactly the strategy you're going into so you can speak to your professional mortgage broker and they'll be able to provide the right blueprint and products to get you on your way. And cash out refinance are fantastic for anyone who's looking to invest into real estate or invest into businesses and using the funds to finance a particular business objective that's going to get them a higher return on their mortgage payments. Now, before all the interest rate hikes were going along, for some people it's actually a really strategic opportunity to go about refinancing their current home to get lower rates and use that to have a lowered monthly payment that they could use towards paying off their home even sooner with better rates. So let's say, for example, your old mortgage is about $1,000 a month, and by refinancing at a lower rate, let's say it's about $950. That's an extra $50 in your pocket every single month. So essentially, you can even invest more to getting your principal paid down much quicker and be able to pay off your home much sooner. And like I had said before, that when you're going about a cash out refinance, many times it's going to be higher than your typical mortgage. However, like I said, at a point where interest rates continue to dive significantly lower in the last 2 years, it actually could have been a more strategic approach, especially if your original mortgage was about 4 to 5 years back, where rates were about 3 and closer to 4%, in which rates within the last 2 years were closer to 2% and even lower, so you're actually saving 2%. Now, cash out refis typically have a little bit more differences in terms of the underwriting, can be a little bit more challenging to obtain. However, if you've got a great credit score, great income, and everything else that'll help your credit profile, you should be in good hands. Now let's talk about the home equity line of credit. Now the difference here is that the home equity line of credit is essentially a second mortgage that you're using to extract your equity to use for anything you're looking for, renovations, investing in other property, and so on and so forth. Now, do keep in mind these home equity line of credits, also known as HELOCs, tend to have higher interest rates than if you're to have a standard mortgage on a property. Now, if you're someone who actually refinanced in the last 6 to 8 months, you probably had a much better rate than you had on your previous mortgage, given that rates were higher in the 3, closer to 4% range. So essentially, home equity line of credit is essentially a line of credit on top of the existing mortgage you have on, let's say, a primary residence or even one of your rental properties, in which as you continue to pay it down, you're building equity as well. And with a lot of these programs, they tend to have what's called like a step program with Scotiabank, in which it's kind of like a revolving door line of credit that as you continue to pay down the loan, you have the ability to access more of the loan over time that you can invest into more property. I will say with these credit products, you cannot have a bad credit score. You have to have a good credit score you have to have a good income, your properties have to be performing well in terms of its income, and you have to have a low debt ratio. So it's something to keep in mind that if you have all those elements, you'll be able to receive these type of products that'll help you scale in a much quicker time frame. So as an example, like I said earlier, let's say you have $100,000 of equity and the loan is 80-20 value. Let's say you're given an $80,000 line of credit that is separate to your existing mortgage, in which it's a secondary mortgage or a secondary line of credit, in which over time, as you continue to pay it down, you have the ability to take out more over time, which, like I said, you could use for multiple rental properties, which is fantastic to build your financial future. Now, the funds that we use when we refinance, of course, was for our first rental property through the equity of our primary residence. But not only would it help fund the down payment, it also helped with paying off our student debt. Think about it this way: you're generating income, you're removing your debt, and you're having someone else do that for you, and you're cash flowing every single month. What else can you ask for? Add to that all the equity you're receiving every single month from paying down your mortgage. Now, just like a cash out refinance, it's not free money. You're still gonna have to pay your mortgage payments, or at least minimal interest, or whatever it is, the arrangement you have with your lending institution. However, if you're doing things the right way, your rental property should be able to cash flow to pay for not only its primary, but also the secondary mortgage, depending on the market that you're in, and be able to pay off all the expenses and give you a little bit of cash at the end of the month. Now, I will say some markets that are a little bit more mature, like in the Southern Ontario market, that becomes very, very, very challenging to do so. However, in some US markets, that's still very capable, with properties being around $100,000 or even less. Which, as a reminder, that's why we're investing into the US. We're in a market where properties, some of them are going for under $100,000. We're getting decent rents, we've got good property management, we're getting good cash flow, we're building equity every single month, and we have the ability to scale quicker than we would in Ontario, because the price tag of a home in St. Catharines, where we originally invested, we could have bought 5 to 7 properties with that same price tag out in the US. With these type of lending products, they do typically allow a 30-year amortization, and there's potential talks of there being a 40-year amortization, which is fantastic for investors because it'll keep your payments low. Yes, you'll have a loan for a much longer time frame, but if your properties are still cash flowing every single month, then why not? That's just having someone else lend the deal for you, and you're gonna have someone else make the payments on your behalf. And that's what I love about home equity line of credits. Not only do you have the access to use your equity to buy rental properties, but as you continue to pay it down, you can continue to use it over and over and over again, as long as you're making the payments. Now, what other better financial product out there in terms of lending is there? That's what we always find it amusing when people have homes worth $1 million, $2, $3, $4 million. They never refinance, they sit on that cash and miss the opportunity to have 5 to 10 properties within a very short time frame with great cash flow, giving them the ability to leave their job at a very short notice. Definitely much shorter notice than those who have to work all the way till 67 years of age here in Canada or 60 years of age in the US. And remember, a HELOC does not have to only be from your primary residence. If you have multiple rental properties who have enough equity, you can go about extracting equity from those properties and use that to purchase more rental properties, have it continue to go on and on and on. And if you like, you can always have at least one rental property, refinance it, use it to fund the renovations of another property to really boost the value. So let's say you have a duplex and you want to increase it to, let's say, a fourplex. You could refinance from one property, use those funds, and make the upgrades on a different property. It's all about finding different solutions to increase and enhance your portfolio, because the more income you're generating, better for your lifestyle, better for your financial freedom, and also better for lending. Banks love seeing that your properties are generating more income with expenses being lowered. It shows that you're very efficient financially, and it shows that you can be handled to be given more loans in which you can use to purchase more cash flowing rental properties. Now, I will say, in the event that you're not able to make the payments on your HELOC, that is going to come back in terms of the bank having access to your primary residence, in which if your properties are in a really tough situation and you don't have the funds, it makes it easier because the banks are going to be in first financial position, that in the event that you're not able to make payments, you may be potentially forced to sell your home in order to make those payments, or they'll go to collections and any means necessary in order to obtain their money. That's why it's very important to know exactly what you're doing it very strategically, and having the blueprint in place so you're not put in a position that you're winning for 6 months and then all of a sudden something takes place and you're in a terrible predicament. You want to know exactly what you're doing at all times and make sure you're making the best move for your future. Now, do keep in mind that if you have poor credit, if you have too much debt, bad income, and so on and so forth, it's going to be really challenging to get your home equity line of credit approved from any lending institution. Now, I will say not every institution is the same. Some lending institution underwriting is going to be a little less stringent, and some are going to be more stringent based on your portfolio, your credit score, your profile, your income, and everything as such. So remember, you want to speak to a professional mortgage broker who has access to many different lenders. In the event that one of the A-type lenders aren't willing to help you out, which they typically have the best rates, you could always go to a type B or C-type lender where it's going to be higher, maybe along 5 to 6, 7%. However, you're still able to get what you're looking for in terms of refinancing your property. Horizon Thermal and I love the home equity line of credit. We can essentially extract it using a line of credit, continue to pay it down, and continue to reuse it like a revolving door, where you don't necessarily have that option with the cash out refinance, but it is nice knowing you have the cash option that if you need it for anything dire or renovations or anything as such, you're able to use it for those means. But ideally, you want to use it for building your rental portfolio. I hope that video was super helpful, insightful, and gives you all the information you need to compare if a home equity line of credit or a cash out refinance is best for you. I'm Josh Tavares, investor and realtor with eXp Realty. It'd be so nice if you can help us out and hit the like button, hit the subscribe button, hit the notification bell to get updates on our newly uploaded content. And if you're looking for great cash flowing properties at a low price point, great cash flow, great appreciation, then go to the link in the description below, book an appointment, and let's get you on your way. Thanks so much for watching, guys. Take care.